Okay, let's have a look at specific company, which called CBOE Global Mkts. Company itself was founded in 1973 by Chicago Board of Trade, and for nearly 30 years it was in private hands. It wasn't publicly traded, and only in 2010 it had an IPO, and you could buy the shares of it on a new, at that time, NASDAQ. They put it on NASDAQ. Now, after that, like after its establishment, they grew through acquisitions. As I already explained you, that majority of these companies, it's quite difficult to manage in the sense of legal requirements. It's quite expensive. So what they do, they join together. They create mergers, acquisitions, and they grow bigger, bigger, and bigger, and bigger. And at the moment, CBOE Global Mkts, one of the biggest company which owns several exchanges. Now, they have 4 option exchanges. As you can see, they have 7 equities exchanges. They have 1 future exchange, and then they have 1 foreign exchange. So practically, you can trade any security using their exchanges. Right. So if you look at the source of revenue, for example, in 2019, it was broken that 62%, nearly 62%, it was transaction fees. So when people buy and sell, or companies buy and sell, right? And 37%, it was from additional services. Mena is writing that it's nice business model. I agree, it's a fantastic business model because you cannot go wrong here, right? If people selling, you make money. If people buying, you make money. Doesn't really matter what people do, you still make money. The only people they don't like, value investors, because value investors buy it and then hold for years and don't do anything with that stock, right? So that's why brokers, that's why exchanges, if they provide any education, they usually provide you trading education. They teach you how to trade, and the more you trade, the better for them. Okay, you understand probably that's the measurements. So, but still they created additional services where they provide management for you. Okay, this is the company itself. So let's have a look. I presume from business model you understand. For guys who don't know what the exchange is, it's the place where you trade stocks, trade securities, different type of securities. So the way it works that if we have, for example, person like myself or you, and you've decided to trade, something to trade, you cannot go directly to the market, right? The way you do it, you go to the broker. So the person who helps you to install software on your computer, create everything, and after that, the broker looks for another seller. If you buy something, they look on the market for different seller or buyer of your particular stock, right? So, and the market is just the place where it happens. It's similar situation. If you go, I don't know, we have a lot of markets here, and if you go to the market, there are traders there who buy and sell, but then the market itself, which makes money regardless, because it's the people who trade there, they have to pay money for this service. Okay, let's go into fundamental analysis. Oh, by the way, if you go to their website, that's what you can see. CBOE operates not only in United States, they also have branches in United Kingdom and the European Union. Okay, and that's what they trade for. This is how value line report looks like. Initially, it might seem quite complicated, but in reality very simple. I will try to go step by step and explain how it works. Now, first of all, the name of the company, the current price. By the way, can you see my mouse? When I show my mouse, can you see the mouse? Okay, perfect. So the current price is $93. It's a bit higher than here. I'm just checking if on the pre-market is change. I have another computer open here, CBOE, still $93.33. So current price, so just a bit more. This report is done 10th of July, as I explained you, and we can see that P ratio, price earning ratio, is 23. So it means that people pay now 23 times for $1 of profit this company. Now, current level of dividend is 1.6% from the current price. Okay, not a current price $93, so it's about 1.6% annual dividend. Now, value line have certain kind of parameters here, right? And one of them is timeliness. Timeliness is the parameter which shows what potential this company has within the next 12 months. Out of all their database, they identify 100 companies and they give them parameter 1, timeliness 1. 300 companies, they have parameter 2, about I think 700 or 900 for parameter 3, and then 300 and parameter 5, and they have 100. So CBOE has the highest potential for growth within the next 12 months. Safety, they have 2, so it's quite safe company, and the volatility is 90. Now, in normal circumstances, I would prefer something volatile as market or even higher. I prefer that. But right now, when the market is so high, low volatility means that if the market goes for, let's say, $10, this one will go slower. It won't lose 10%, it will lose only 9%. If the market drops 20%, it loses maybe 18%. So it's kind of lowering drop, so it's good for us. Now, value line believes within the next 18 months, the price can be between $83 and $181. The midpoint is about $132, so it's much higher than the current price. So, but if we look at 3 to 5 year projections from value line, they believe that the price might be between $140 and $190, which represents from 12 to 21% annual growth. So if you buy that company and hold for 4 years, value line believes that it's going to be somewhere here. Now, for us, it's important to know how value line assesses. Value line has a huge experience in projection, this type of stuff. So we have to pay attention to that. It's not always exact because the situation in business can change. So in this case, value line changes these projections as well. But still, you can use it as certain guidance. We have our own table. We have our own Excel sheet where we analyze it, and then we compare these numbers, which value line has, with our personal numbers, and then we compare how close they are or not. Now, Daniel is asking, beginner's question, how can we predict the future volatility by looking at the past? Volatility, we cannot predict volatility. Volatility depends on a lot of things. It could be political, economical, it could be, let's say, virus, right? But we can expect that something will happen. It's like if people get married, even they love themselves very, very much, you can definitely tell that they will have arguments. Like, you won't know when, but you definitely know they're going to have arguments, right? So same story with businesses. You don't know when, but every business, they have certain struggles. And sooner or later, it will happen. And for us, the major thing is to identify when this problem happens, is it solvable or not? If it is solvable, then it's going to be good. If it's not solvable, we have to stay away from the company like that. Okay, but when we finish the analysis, probably it will become more clear for you how it works out and how we identify the future price movements. Now, so let's have a look the first line here in the table. We can see revenue. Revenue is how much of product is sold based, like, compared to one share. So for one share, if you go lower, you can see revenue. Here is within the company itself. So you can use both of these parameters. They're kind of similar, not exactly the same, but similar in sense of potential of growth. Why? When I talk, and for example, I tell they sold $437 million. For some people, it's very difficult to understand it. Okay, how much is that? But when I tell $4.85 per share, and they know they have 10 shares, they understand. So it means that for my amount of shares I have, they sold $48 of products. Okay, that's how it works. So we can see that the company started operating in 2010, and we can see that that's the growth. So initially they sold products per share $4.85, and in 2020, this year, they are planning to do $27 per share. So it means that the company in generally growing. Okay, it's a growing company. So for us, it's also important the consistency of the growth. If the company might grow 1 month, year, and then drop in a couple of years, and then grow again, and then drop in again. So for us, it's more important consistency. So let's have a look. 480, 570, 580, 650, 730, 770, $8, $19, the huge jump. Here they bought in several exchanges in United Kingdom, so for $3.5 billion at that stage. So that's why their sales revenue straight away jumped up. Okay, and here we can see the first drop in sales. So in 2018 they had $24 per share sales, and then 22. So it's close to probably 7-8% they had lost in revenue. But this year, in 2020, remember that this report was issued 10th of July, just 10 days ago. Their projection that they're going to make $27 per share. So they're actually not only making more money than the last year, but also in the previous year. Okay, so the growth, and then $28, $33. So guys, do you think it's a good that the revenue and their sales levels growing up? Put pluses if you think it's good, right? And but for us, it's more important not only revenue, right? For us, it's more important the money which they make, the net profit, because it doesn't really matter how much product we sold. If we sell it with a loss, it's not good for us. So let's have a look. Again, in 2010, they had $1 profit. So the third line here, earnings per share, it means the net profit which they made after taxes, after everything, after all expenses, whatever left, okay, after everything. So that's what we know. They made $1, then $1.5, then 1.7, 1.9, 2.2, and etc., etc., etc. We have a slight drop here, and usually it happens because that happened on the year when they bought, right? Usually during that year they have a lot of expenses, legal audits before they buy, especially big company, big chunk, it's costly. So I presume that's affected their earnings, and they had 20 cents below the previous level. Okay, we have this kind of not consistent growth, but then look at this from 2.2 to 3.6. It's more than like 50% increase in earnings, right? Then again increase, and again last year a slight drop. So we can see that in 2018 something happened from 2018 to 2019 that's affected the sales level and also the earnings level, also about 10% drop. But they say again they are planning to close the year with the $4 of profit. Okay, for us it's important. Yeah? Can we trust that company or not? Can we trust them if they can make that money or not? Maybe they tell us that they're going to do $4, but in reality they will do only $3 or $2, right? So, and that's why we always look at one parameter which called predictability ratio. Okay, and I will show you that predictability ratio here is 45. So it means that only 4 times out of 10 they're right about what their earnings are going to be. Do you think, guys, is it good or bad? Okay, the questions, are these value line reports available? No, you have to pay for subscription. It's paid subscription. they provide the services. Some of the information is available at value line subscription product that club members have access to. Thanks, man. I'll reach later to get more information. Might be both. Igor will also share a bit of more, but yes. Okay, so this is now. Let's have a look. I'm going to just jump maybe ahead, and I'm going to show another service, which is called Estimize. It's earnings projections. Look at this. Now, this chart shows us the actual earnings compared with estimates. Blue dot, this is Estimize consensus. That's what company gives us projection to. Okay, this is line gray area, I think. Wall Street estimates range, company guidance. Okay, the red ones. So here you can see, but usually it's in this area, company guidance. But can you see that they promised $1.2, they made $1.4. Here they promised, they over-delivered. They promised, over-delivered, promised, over-delivered, promised, over-delivered, promised, over-delivered, promised, over-delivered. So what can we say in this particular case? Company is not getting into this earnings predictability ratio, but usually if they're wrong in a kind of in a good way. Yeah, they're sandbagging. I actually found it with a lot of companies established in India, exactly the same. They under-promise, and after that they over-deliver. Okay, so in this particular case, when you see the earnings, even if they miss, it would be a high chance that there would be over-delivery. By the way, guys, what do you think happens when the company posts better earnings? So than expected. Price goes down or price goes up? Yeah, price jumps up. Yeah, quite often happens like that. Not always, but it's quite a lot of situation when it happens like that. Okay, great. So let's continue. Another important thing, we can see the dividends. Dividends constantly growing, non-stop. Every year they increase the dividends. The only thing they are not going to increase it during this year. Okay, 2020, 2021. Okay, going to get the same. Although if something changes, they might increase it, but most likely they're not going to drop it down. So on the top of the value line report, we can see the prices, the highest price and the lowest price. If we look at 1, 2, 3, 4, 5 years, so we can see that the highest price was 72, 77, 120, 130, 120, 120, like 127. And the lowest was 55, 58, 72, 87, 89, 72. So we can see that during the same year, with this exact earnings, the price can change quite a lot, nearly 50%, sometimes more than 50%. Right? So it means that if you're patient enough and you buy always at a low, and then sell it at a high, you can make up to 50% every year, just on the same stock. Just buy it and sell. The only thing you need to know when to buy and when to sell, right? Very simple stuff. And I presume if you knew that, you would be sitting in Hawaii right now, right? Or maybe somewhere in Manly have a huge villa. Now, this is kind of a bit tricky. Another thing which is very important for us is price-earning ratio. This is the ratio which I was talking about. And how much money, how many dollars people are willing to pay for $1 of the profit, okay, net profit. So let's have a look. In 2010, when the company went public, they were paying $24 for $1 of profit. If you take this $1 of earnings, multiply by 24, it becomes like around $24 in average. So you see the prices were volatile between 19 and 34, somewhere 24 in the middle, right? So, and you can calculate like every year, and every year it would be somewhere in between the highs and lows, right? Because it is average price earning ratio. Okay, but let's have a look. Usually for the last 5 years, we always take into consideration last year. So that's what we can see. 32 times, 28 times, 25 times, 29 times, 25 times. Now, guys, somebody is drawing on my slides. So be careful, please. Now, and at the moment it's 23. So what do you think, guys? Is it on a lower scale or on a higher scale now? What do you think, guys? Put it in the chat. Okay, lower, correct. Because at the moment they are paying only 23 times for $1 of profit, and only last year they were paying in average 32 times of their earnings. So based even on that result, we understand that at the moment, based on fundamental analysis, CBOE is a bit undervalued, okay, at a low scale. We're going to go in more details a bit later, but that's the way. So then we can see that operation margin is quite healthy, 29%. We can also see that income tax rate 27%, net profit margin 15%. So it's quite good again. And the good thing about this business that it's they practically, not the monopoly, but I presume they have certain agreement with all other exchanges, and the prices are practically the same, okay, everywhere. So you cannot avoid them. You still have to use the market. Okay, another thing which I wanted to show you is the amount of debt, because debt is very important. Warren Buffett has he's saying that when the tide is low, we can see who swam naked. And the current crisis, coronavirus crisis, showed us who was lack of cash, because businesses which had a lot of debt but didn't have cash, and now they cannot sell, they don't get cash flow, they're struggling, they're on the edge of bankruptcy. Okay, so that's why it's always important to know the level of debt. We can see here that it's $868 million. Seems like quite a lot, but when we look at market capitalization of this company, it's only 10 billion. So it's only 8% of capitalization. Also, we also have to look at how the company can manage its debt. So we can see that the net profit this year, they're planning to have $440 million. It's after all taxes, after everything, right? So it means that if they decide to pay all their money, all their earnings and cover the debt, it's enough for them 2 years to cover this debt. Okay, so it's pretty good ratio. And also if we look at cash flow, it's actually what cash they get, because there are different parameters for expenses like depreciation, like writing of goodwill, and etc. So we can see that their cash flow is what, about 30%, more than 30% higher than their earnings. So it means that they're getting cash probably around 600 million here. So they can pay it within 1.5 years if they wanted to. It's one thing, all right? So about this part, I presume that's everything. And you can see that they took this debt in 2016 when they bought these exchanges in United Kingdom, right? Also what they've done here, they increased the amount of shares. They had 81 million of shares. They had another issue and 112 million shares, but at the moment, look, they are buying them back. So the amount of common stock is going down. So 112 million, 111, 110, 108 this year, then they continue to buy. Okay, so if we actually go to the next page, we can see here that value line tells us about it. So last month, the board of directors stuck on another 250 million to its stock repurchase authorization, and the company now has just under 350 million available to buy back shares. And if we see that the current valuation of whole company is $10 billion, so you can buy the whole company for $10 billion, it means that 3.5% is going to be bought back. So the company buys back these shares and then they kind of delete them. So it means that the value of your share, if you're owner of this company, becomes bigger. Okay, this is kind of good stuff. Let's have a look at their balance sheet from the current perspective. So we can see that cash assets, $200 million. So they have cash on their account, even though they owe about 800 million dollars. So 200 million they can pay straight away. Okay, this is a good stuff. And also the balance is quite healthy. Account current assets 330 million and current liabilities 350. So they have quite a good surplus here. Let's have a look. We already saw like in the previous page, that we have a growth, but we couldn't calculate by looking at that what's the percentage. Here there's a special table which shows us what's the level of growth was. Now for the last 5 years, in average, the revenue, the sales level, was growing 27.5% every year. Earnings, 12% every year, so at net profit. Dividends, 12%. Book value also was growing. Now about book value, I will tell you a bit later, something else. Now they are planning for the next 3 to 5 years, their revenue grows 6%, but the earnings 12% as well. Now we have to always ask the question, can we trust those numbers? And usually my opinion is like that. Okay, so if I can see that they had already this type of growth, they already made that money, so I can say yes, okay, I trust them. But if, for example, before they used to do only 2%, 3% growth, and now they're telling me that they're going to make 12, sorry, but I'm not going to believe that. So, okay, in this particular case. So I can believe the low level, but not the higher level if they never had in history growth like that. So here, kind of trustable numbers as well. So when you look at the this information is quite very important. The first paragraph, I think we have to take it very seriously. Look, share earnings soared 67% on a 53% revenues during the intern. So during this period of the coronavirus, a lot of people increased their trading activities. A lot of banks, a lot of hedge funds, a lot of like institutions, they started trading much more. And of course, global markets, they're making more money. But the interesting thing that the current price doesn't represent this move. If we look at the current price, and we're going to look at it in a minute, it's lower than last year. So the question for everyone is, why the company, which is making more money right now, you can buy it cheaper than last year when it was making less money? Why? And here comes the great opportunity for us. Usually we try to find these particular companies which are undervalued for whatever reasons, right? And then we choose this company and buy them and make money. Okay. Now also we can see that CBOE has strengthened their business, and you can read all of this. If you want, I can put this value line report for that specific company into our group. So, and if you want, I can email it to the guys who are not in our group, because we have a private Facebook group where you can place this report. But if you don't have, if you want this chat, just let me know in this, and we can email it to you later, maybe tomorrow or something like that. Now, and also look at this. Value line tells that these quality shares are favorably ranked for the year ahead relative price performance, even though the stock price has recouped nicely from the middle March slump. It's still down about 20% since the start of the year. That said, at the recent quotation, CBOE offers robust capital appreciation potential and decent total return possibilities over 2023 to 2025 trade. Okay, so that's how value line believes about this particular stock. Okay, and we can see that they never had even one quarter when they had drop in earnings like a negative. So always profitable company. All right, guys, usually during this period of time, after I finish this report, I ask our members, what do you think about this particular company? Is it good company? Is it solid? Is it quality company? Is it undervalued or overvalued or normally priced? Can you please put in your chat your opinion, and then I'll show you my opinion. Okay, so what I come up when I put these numbers in the spreadsheet. Guys who are new, if you can, like, based on whatever you learned now, or maybe on your personal gut, to tell, is it a good company? Would you put money in this company based on information which you learned right now, or not? Okay, would you research more about it? So what would be your opinion? At the moment, we look at it as a business. We're not deciding if we buy at that price or not, but if you like put your opinion, it would be nice. Okay, David is very good writing. William looks good. Okay, great. Sarah looks good. If the price is right, okay, correct question. Okay, fantastic. And what about guys who already members? Okay, man, so far so good. Okay, I maybe missed. I want to find the opinion of our members, guys. Nona solid. Okay, great. Okay, nice to see that. Okay, let's okay, correct. Very good one. Very good, David. Yes, question.